Saving and investing can feel slow for years. The numbers move, but life mostly feels the same. Then one day, your investment account shows a number most people spend their whole lives chasing. $1 million. And suddenly the conversation about money starts to change. Because at that point, you're not just saving anymore. Your money can begin producing real income on its own. The decisions you make start to look different, the risks feel different, and the opportunities open up in ways most people never experience. So today we're looking at what reaching $1 million invested actually does to your financial future. And one of the biggest changes is something most people don't expect until it happens. $1 million at a reasonable market return produces real income. If your portfolio earns 7%, that first year shows about $70,000. That's not pocket change. That's a paycheck in its own right. $70,000 a year covers a lot of lives. It covers what many households pay for routine expenses. It covers travel, repairs, and the occasional splurge. It also changes the way you plan the next year. You start from a place that is not defined by monthly paychecks. You start from a place that includes ongoing investment-generated income. Small amounts feel small. $10,000 earning 7% gives you $700 a year. That's a nice lunch fund. $50,000 gives you $3,500. Helpful, but still tethered to a job. $1 million gives you $70,000. Different scale, different set of options. This is why people who hit this mark talk about a new kind of freedom. It's not magic, it's math. Scale alters risk, the way distance alters perspective. A 10% market drop on $50,000 is $5,000. You notice it. You can sleep. The same 10% on $1 million is $100,000. That's a hit you feel in the chest. The numbers are the same percentage. The effect in dollars is huge. This is the core shift. Your daily portfolio moves now match or exceed salaries most people earn in a year. Your attention follows money. Your attention multiplies. That attention can be good. It can be dangerous. Seeing five-figure swings fosters new habits. Some people check their apps all day. They refresh. They obsess. They micro-react. They buy or sell from emotion. Others breathe and keep the plan. The sensible path is to have rules before the market makes them necessary. A written plan beats panic every time. Rebalance on a schedule. Keep a core portfolio and a satellite of opportunistic plays. Use thresholds to decide when to act. Strategy trumps headlines. Another effect of scale is optionality. With substantial capital, you can say yes to things that were previously impossible. Private funds that require big minimums become available. Real estate deals that need serious down payments make sense. Business acquisition opportunities that once felt out of reach now sit in playbooks. Those are doors that open only when you can commit capital without risking daily life. The economy creates those doors because scale creates distinct, trackable opportunities. When most people have tens of thousands and only a few have millions, the few with millions get access to bigger bargains. Lenders notice this too. The financial system treats you differently when you bring substantial assets. Banks offer better terms for mortgages. Credit lines appear with cleaner pricing. You can borrow against a portfolio. You can use bridge financing. That cheap credit can be a tool if used carefully. It lets you move faster on deals. Speed matters. The fastest negotiator with liquidity often wins the best deals. Liquidity matters more when prices shift quickly. This is when leverage stops being reckless and becomes tactical. Small accounts use debt as a crutch. Big accounts use debt as a lever. One can buy an income property with a mix of cash, mortgage, and a secure portfolio as backstop. The math of buying a property, rent, cash flow, repairs, gets sweeter when your balance sheet can absorb surprises. That combination of capital and access to credit is how many investors accelerate from 1 million to more. They use other people's money intelligently while their own capital shields downside. Earnings from investments change behavior. When investments generate money that covers significant living expenses, work becomes a choice rather than a necessity. That is a huge shift. People who were trapped in jobs they hated begin to see alternatives. A lower-paying job with more meaning becomes attractive. A risky business idea can be tested. A sabbatical becomes possible. The psychological leverage of having a safety net frees people to make better long-term choices. The desperation choices, staying at a toxic workplace, accepting poor contracts, fade. You negotiate from a place of strength. Time itself takes on value in a new way. Before the million, hours are traded for dollars and the math is linear. After the million, the calculation includes the value of time in years. Time for family, time for health, time for projects that scale over decades. People begin to use time differently. They take trips that matter. They pick work that builds legacy. They invest in relationships. These are hard to measure returns, but they are real. And they are only possible when immediate survival is not at stake. Taxes become a bigger lever once the amounts involved are large. A small investor ignores asset location because the math is tiny. A larger investor optimizes location because the difference between paying a higher tax rate and a lower one translates to large after-tax sums. Strategies like tax loss harvesting, choosing between taxable and tax-advantaged accounts, and estate planning begin to return real dollars. The time and cost of advisors start to make sense. Hiring specialists moves from luxury to smart business. Professional-grade advice becomes useful. When your numbers run high enough, a fiduciary planner can save more after-tax dollars than they cost. An attorney can structure trusts for efficiency and control. An accountant who understands complex investment returns can identify savings that stack. These services are not for vanity. They are for protection and optimization. Good help prevents avoidable mistakes. Wealth at scale invites new risks. Advisors are part of the defense. Psychology changes again when the portfolio size increases. Accumulation gives way to stewardship. The mental model shifts from how fast can I build this to how do I keep and use this. That is a different exercise. You ask new questions. How much do I need in liquid reserves? How much can I lock into illiquid high-return plays? How much is safe in equities? How much should be in private deals? Central to this shift is the recognition that losses at scale hurt more. A disciplined mix of growth and protection usually follows. Market downturns read differently at scale. At low balances, a crash is scary and can be catastrophic, but recoverable with time and consistent contributions. At high balances, a crash can wipe out many years of gains in nominal dollars. That is why many who reach seven figures tilt toward lower volatility. But they do not all get conservative. Some keep high allocations and accept larger dollar swings. Each path fits a temperament and needs. The rational choice blends temperament, time horizon, liabilities, and goals. Optionality is also social. When your investments can support life decisions, family choices change. Having children, supporting family members, or helping aging parents is less fraught when money is not the immediate limiter. The decision to relocate for care or to help a sibling with college costs becomes feasible. You gain the freedom to prioritize values over immediate budgets. That optionality reshapes relationships. Legacy thinking moves from an abstract idea to practical planning. At $1 million invested, the conversation shifts beyond the spender's next purchase. People start asking how to preserve wealth for heirs, charities, or institutions. That brings estate planning into play. Trusts and charitable strategies matter. The capital becomes a tool for long-term influence, not just current comfort. The conversation pivots from personal survival to stewardship across decades. Compound acceleration is a mechanical advantage that feels almost unfair. Percent returns applied to bigger bases produce larger absolute gains. The math that got you to 1 million now works on a larger number, so growth becomes visually and materially faster. This does not mean returns increase. It means the same return yields bigger dollar amounts, which you can then reinvest. The second million often arrives faster than the first. That creates momentum. Momentum makes future planning easier. Access to different asset classes matters a lot. Many private vehicles, syndications, and alternative funds have minimums that are impractical for small investors. With larger capital, you can diversify into these areas without over-concentrating. Those investments often carry higher yields, albeit with illiquidity and complexity. Allocating a modest percentage to such opportunities can raise portfolio-level returns, but it must be done with judgment because lockups and special risks are real. The social side of wealth is tricky. Conversations about money change. Your friends may still worry about monthly rent. Your swings in net worth may outsize their annual income. That can create distance. Even well-meaning people may not grasp the specific trade-offs that accompany wealth. This can feel isolating. Managing relationships requires thought. You need to talk to people who understand your context while staying grounded with those who keep you human. Behavioral traps multiply with scale. Obsession, herd mentality, overconfidence, and fear all arrive with larger accounts. Compulsive monitoring and reacting to short-term noise produce bad moves. The antidote is process, a clear allocation plan, thresholds for action, an emergency cash buffer, rules for rebalancing. A small, consistent habit of checking less and planning more protects long-term outcomes. Insurance and legal structures gain importance. When you have assets that can meaningfully affect your family's years, you add legal protection. Liability insurance, umbrella policies, and appropriate entity structures reduce personal risk. You protect the base so it can continue to function. These defensive steps are part of running wealth like a durable enterprise instead of an ad hoc stash. A paradox appears. The more you have, the more you can lose in dollars. But the more you have, the more optionality you gain to make asymmetric bets. That is the space where many wealth builders thrive. They keep a stable core and use a satellite to pursue higher return, higher risk plays. The satellite can be private equity, a business purchase, or a niche real estate strategy. The core keeps the lights on. The satellite chases growth. Together they balance safety and upside. Leverage becomes a nuanced tool. Banks will lend against securities or income-producing real estate. Margins can fund quick positions, but leverage must be measured. Good leverage enhances returns without jeopardizing stability. When used well, it multiplies opportunity. When used poorly, it amplifies loss. At scale, the margin for error is both larger and more consequential. Your decision-making horizon stretches. When you aren't forced to sell assets to meet short-term needs, you can pick investments that require time to compound. Illiquid investments often reward patience. You can own private businesses that need years to scale. You can finance a portfolio of rentals that gradually increase in yield. Having time as an asset changes the kinds of ventures you can pursue. There's also a shift in how you judge consumption. A $10,000 purchase feels different when your investments generate that amount in a month versus when you need a year of work to afford it. Big purchases no longer require liquidation of the future. They are judged by opportunity cost relative to passive income. That changes shopping lists. It changes travel. It changes what afford means. Alongside opportunity arrives responsibility. Once you reach this level, how you handle money affects others. Family expectations rise, requests for help grow, your decisions ripple. That is part of the stewardship role. Rules help. Decide in advance what you will give, what you will loan, and how you will respond to family asks. Clear policies prevent guilt-driven mistakes. Professional relationships matter more. Firms that manage wealth provide access to deals, advice, and implementation. Working with fiduciaries ensures that recommendations align with your interest. Fees matter. But fee decisions should be cost-benefit analyses, not automatic rejections. A planner who saves you more in taxes and inefficiency than they charge is worth hiring. One of the clearest changes is how you see failure. At small scales, failure can feel terminal. it can set you back years. At larger scales, failure often means returning to a previously comfortable base. That lowers the psychological barrier to experimentation. Entrepreneurs who keep a strong portfolio can pursue ventures that would be reckless otherwise. The downside is manageable. The upside is real. If you aim for this threshold, build systems first, automate savings, capture employer match, pay high-interest debt, create a durable emergency fund. As you scale, add tax planning, consider private allocations carefully, and formalize a risk strategy. Build a small team. Protect the base with legal structures, keep the core diversified, use the satellite for upside. If you found this video helpful, make sure to like the video and subscribe to the channel for more simple breakdowns about money, investing, and financial freedom. Also, let me know in the comments. What milestone are you currently working toward with your investments? Thanks for watching, and I'll see you in the next story.